This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thanks for joining us. Once again, we have Harry Dent as our special guest. We'll be talking about what he thinks is going to happen to asset prices, including real estate. Now, by the way, how are stocks typically leveraged, or are they owned cash?
No, real estate is more leveraged. So real estate is much more a problem. The 2008 crisis had a lot more to do with the real estate. Real estate went down 34%, Bruce, on average in the United States. That was higher than the Great Depression at 26%, because in the roaring 20s, the Great Depression, people couldn't borrow money easy, and most people couldn't buy and finance a house easily and leverage it up and speculate. It was a stock bubble, not a real estate bubble. But the real estate going down is the worst, because real estate is backed by high debt. And when those debts default, as in 2008, that's when the problem goes. Stocks go down, but it's more rich people that own stock. People do not tend to leverage outside of traders to buy stocks. So I look at stocks more as the trigger for another real estate crash that goes down 40 to 50% this time and really stresses the financial system.
All right, let's talk about that, because that's what I feel like I understand. And so can we bat that around a little bit?
Sure.
Okay. So that's a hit that's equivalent to 2008. But what's different is what's in place. Low interest rates, fixed rate loans, not pretend loans. People had to qualify. They have payments that are manageable, and they have the biggest equity position ever. So I want to bat it around with you, because I'm looking at the history of what I pay attention to. And for you to have price damage in real estate, the market has to be dominated by foreclosures. That's how you have price damage.
Okay. Here's the difference between this time and last time. You're right. Real estate was more overvalued relatively. Okay. But baby boomers were close to their top in the real estate cycle. We are way down the real estate. You know what I would have predicted for real estate without all this stimulus? Bruce, real estate would have been down for the last 10 years. From lack of buying versus supply, okay? So all of this has been built up. Lower interest rates, government's giving people money, fake earnings, fake GDP. Of course people spend more on real estate, or maybe buy a vacation house they wouldn't, or trade up to a bigger house. It's all fake, okay? It's fake, fake, fake. The problem is this recession comes with a much more fake economy. Of course, people have a little more equity in real estate. The government gave everybody a free gift, okay? If Uncle Sam came and walked up to your house and gave you $100,000, would you feel richer? Did you earn it? Is it real? No, but you would feel richer, and you might act differently for a while until you did what? Oh, bought even more, leveraged up even more, even though you're older and can afford it less and moving towards retirement. And interest rates are going down, which means you can't get the same return. This is a total BS economy since 2008. That's the problem. This time we come in, yes, real estate is adjusted for inflation only a little bit higher, okay? But compared to the natural demand, it's 40% over. I've got indicators for this, Bruce.
Okay.
40-some% overvalued instead of 20. And I'm telling you, it's going to go down 40 to 50% this time instead of 34%. And that doesn't cause havoc in the banking. Oh yeah, people have a little more equity. Sure. Yeah, try dealing with a 40, 50%. I tell people right now, anybody in this audience, what was your house worth at the bottom of the last real estate recession in 2011-12? That's number one reality. Could you take that decline, and would it hurt you? And the bigger reality, what was it worth before the real estate bubble started in the first place in early 2000? Look at those two figures, and if you're not scared to death, then you're bought in Omaha and don't have to worry much. Okay. That's what I'm saying. This is going to be a big shock.
Okay. The trigger point for 2008 had a lot to do with real estate financing. which
Yeah.
took over the bond world. So what's the trigger here? Because it doesn't seem like it's the front line is real estate. It's going to be down the stream gets damaged because of what's the event that goes first?
The trigger is a stock market and all financial assets, including real estate, that are going straight up at the fastest rate in all of history, while demographic trends and the fundamentals of the economy go straight down. A huge, just a jaws, okay? Boom. That's the trigger. It's not going to take much of a trigger. I don't think there's going to be a giant trigger right now, except that stocks start falling and they don't stop. I have a megaphone pattern stock since 2008, January 2018, higher highs, lower lows. Megaphone patterns only come at the end of long-term booms because the momentum in investors and consumers and business minds is, oh, we've gone up forever. So the people are still bullish. But what happens is you get slightly higher highs, but every crash takes you to more substantial lower lows. That's what we've had since January 2018. Actually, we've had it in a broader level on my broader cycles from 2000 to 2021. So this is the thing. It's the overvaluation of financial assets, which was the cure for the debt crisis and the demographic crisis of 2008 that's going to cause this bust, which means, oh, people don't have to spend less because they've already been, the demographics peaked in 2007. Housing doesn't have to be more overvalued than last time relative to incomes or something else, because everything else, it's the stock market, I think, is going to be the biggest trigger. I think the next crash on my megaphone pattern, that's one of the most reliable. It's no pattern short term is reliable, but the megaphone pattern in the stock market says next bottom for the S&P 500 is 2100. It's sitting at 4209 or something today. That's a 50% crash. And Bruce, let me tell you how long that'll take to happen. 2 to 4 months. Now, this may not happen. That's my most likely scenario. That alone will give such a shock to this stupid, overstimulated, overbloated economy that it will not recover. We will not see a new high. And nobody will believe. If they just stimulated 55% of GDP in the last year and a half, and that didn't work, who's going to believe, oh, now we're going to print 20 trillion? No. Government loses credibility, economy loses credibility, and people go back down to me, like me. I'm 68 years old. Why am I buying a second vacation house? What's wrong with me?
Charlie Dow wrote in a book called ABCs of Investment. This is 1890. He says, you can always tell where you are in any cycle by the emotion of the participant.
Yeah, the stupidity of, the delusion of the participant.
So
people are most delusional. Every time, I'm telling you, the smartest, this is different for me in the past. Now, when I get my forecast, the smartest and the dumbest people say, Harry, there's no way the government will let that happen. Well, I was in UAE, in the most booming country back then in 2007, I think it was, right before they went down. I gave my forecast, real estate, particularly there, real estate's been pumped up, it's overvalued, and it's going to crash 50% or more. And people said, Harry, the government won't let it happen. They will buy when consumers and businesses don't. I said, well, now I'm even more worried. The next year, real estate there went down 50% in 1 year. Real estate does not go down as much as stocks or as fast. That was one of the most extreme real estate bubbles back then. I was sitting there talking to people in that country, and everybody in the audience said, cannot happen. And I get that same thing today. Harry, I had a guy wanting me to debate on radio. I said, I'm sorry, I'm not willing to debate dumbasses anymore. If you say, I'm just saying a 40% crash in the next few months or a little higher, people say, that cannot happen. How fast is the Fed? Did they prevent the last crash in 2020, February 20? No, it happened before they even could react. This one's going to be bigger. Everyone's going to be bigger. So people are delusional if they think, number one, the worst thing, the one thing I've learned in my entire lifetime, and I've studied everything. I've studied back to the Big Bang, okay? Everything. You don't get something for nothing, number one. And number two, things grow. Everything grows long-term, short-term in cycles. Every boom has a bust. Every inflation has a deflation, okay? Men and women, play of opposites. You don't have a boom like this without a bust. You don't even have to have a trigger right now. Things are so overvalued compared to the fundamentals. It just has to have something go wrong and stocks collapse enough that the smart money start to say it's over. And it doesn't matter what everyday people think, but the smart money starts shorting this thing with 20 times leverage. It doesn't matter if Homer Simpson is still buying stocks because they're in delusion about the boom will never end. And Janet Yellen says, we'll never have a recession the rest of our lifetime. That's the stupidest thing I've ever heard from an economist ever. And she's the Secretary of Treasury and was the Fed chairman before that. These are the people running our monetary policy. They don't know anything about anything, never had sex, never run a business. And they have to prove to me otherwise, especially the sex. I don't believe it.
Let's talk about a couple of other asset types. So gold, for instance, is that somehow going to be a safe haven for this?
In the 70s, yes. Now, no. Now, I will give an exception to that. I'm putting out a thing today in my newsletter. Gold in the 2008 downturn went up at first. They saw the economy weakening, so investors say, well, they're going to have to print money. And gold likes printing money, because they think it's going to cause inflation down the road. Well, it didn't cause inflation because the economy tanked. And when Lehman Brothers went down, gold collapsed 33% in 2 to 3 months, okay?
Right.
Gold seemed to be the safe haven coming in the early stages. When the you-know-what hit the fan, gold went down. Now, but gold did not go down as much as stocks, okay? What was the safe haven, which I still stress today, and every gold bug will say, oh, the US dollar and treasury bonds, the epitome, the whole global money printing thing. No, we're the best house in a bad neighborhood. We have way less money printing than Europe, way less than Japan. And China doesn't even print money. They just print condos. They just build stuff for nobody, the worst type of stimulus in history. We're the best house in the global neighborhood. Even though we're going to have a big downturn, our currency, the US dollar, will hold up better, and the US Treasury bonds will hold up the best. Mark my words on this. And it happened in 2008. When gold went down 33% in mid to late 2008, Treasury bonds went up 30 to 40%. So that's the safe haven. Because cash is good because things go down relative to cash, but the Treasury bonds make you money because they've locked in, let's say, a pitiful 2.3% yield on a 30-year Treasury today, and watch if that Treasury goes down to near zero, which is what I'm predicting. That Treasury bond will go up 40%, and forget your 2.3%. By locking in a 2.3% high quality return forever, when they go down to near zero, that Treasury bond will go up at least 40%. And you've magnified your money while stocks and real estate and lower quality bonds are going down. And then in the bottom, you'd be like Joseph Kennedy and you buy everything at 50 to 80% off. Sale of a lifetime. That's the secret to wealth. Joseph Kennedy is two classic examples. One, private. Joseph Kennedy he was not a sophisticated guy in the terms of economics. He just knew that the shoe shine boys were telling him what stocks to buy, and he said, oh shit, I got to get out. I got to get out of this. This is wrong. He got out, reinvested at the bottom, and went from being a multimillionaire to a billionaire in today's dollars. The other great example is Ford had beat General Motors for most of the great race of leadership into the late 20s. And I chart out these things too. There's a time when these happen on an S-curve. General Motors only passed Ford in the downturn because General Motors had better financial controls and was less overconfident. And Ford went down harder, and General Motors passed them forever. You know what the value of the difference between 29 and 33 of passing Ford forever? Zillions of dollars. A couple of years determine that difference. And once you get that advantage, Ford never caught up again. Ford's still a big company, great. No, General Motors still dominates. And if you'd have bought General Motors stocks in 1932 or 29, by the way, versus Ford, you'd have made way more money. So business can benefit from this downturn and investors, but you have to get out of the way. You have to hunker down as a business or as an investor. You have to get in safe haven assets, and it's not gold, although gold is not the worst place to be.
Right.
Safe haven assets and simply reinvest when things go down 40 to 50% in real estate and 60 to 90% in stocks.
Okay. We got only a few minutes left. How about the impact of the tax policies that are being discussed? So let's talk about first wealth tax. So taxing your net worth every year. What do you think that'll come about, and what's the impact of that?
Oh, absolutely. I've been warning about this for decades. In the winter season, which is 2008 to 23 and 1930 to 42 in the past, governments always raise taxes. The economy gets weaker, deflation sets in, and in the boom before that, I call it the fall bubble boom, like the roaring 20s or this incredible bubble, the rich get richer. So people hate the rich, they tax the rich, and taxes go up. You have not seen the beginning of taxes. I'm sitting in Puerto Rico, paying almost no tax. I moved here to finish my vacation home because I like Puerto Rico, knowing I might qualify or not for the tax thing. I didn't know. I moved here anyway. I'm telling you, people are going to be rushing into this country in the next few years, and I'm worried about the tax status in Puerto Rico because too many gringos are going to come here and then they're going to cut it off. So saving taxes are going to go up. They are only going to raise marginal rates and taxes. They have to tax the wealthy. You can't tax the everyday person.
That's right.
When an economy like this goes down and they're out of a job, wealthy people will lose a lot of their wealth. And I'm telling you, I mainly speak to wealthy people. You can imagine, okay? Yeah. Financial advisors and wealthy clients. I tell people, look, the everyday person is going to be in a bad shape and lose their job. I would rather be them than you, because wealthy people like you and Ted Turner in 2000 could lose 90% of your wealth. Ted Turner lost 90% of his wealth when AOL or whatever, Time Warner went down that he sold to, and he was crying on TV. I can't find a woman make love to me anymore. You know, I mean, 90%. He went from 10 billion to 1 billion. And people's like, Ted, what are you worrying about? You're still a billionaire. No, a 90% cut in your wealth. That's extreme. Wealthy people should fear this downturn more than every day. That's my unique message. I can't save everyday people because I'm not known in that realm. I can save some small percentage of more affluent people who've worked hard and built up a business or their financial assets and not think that it's okay to keep buying stocks and financial assets or over expanding your business. I tell people, you got a business now that's done well and your kids don't want to take it over, I would sell it now, not 3 or 4 years from now when you retire or whatever. The financial cycle is everything, and wealthy people are going to lose the most wealth by far in this downturn, by far, than everyday people.
If that doesn't happen, and let's just play out what the Fed will try to do to prevent it or to nip it in the bud, what tools do they have left, and what would they attempt?
Well, the monetary policies started fizzling out. That's why the government had to go to fiscal policies and literally inject money directly into consumer. I would have done that from the beginning.
Right.
If you're going to help the economy, at least give it to consumers and businesses rather than just pump up financial assets, which monetary stimulus is really stupid. But they've already done that. I mean, $3, $4, $5 trillion and more proposed. Now, wait, okay. So that looks scary now. Oh, we just ran a $3 trillion deficit for the first time in an okay economy. Wait till the economy goes down and see when the government revenues go down and they're stimulating even more, you're going to see $5 trillion a year? $7 trillion. I've been predicting, Bruce, only on a simple indicator for 10 or 15 years that by 2026, we would have a $40 trillion government debt instead of the 20 we've had recently and the 10 before that and the 5, because it's been doubling every 2 administrations since the first Bush.
You'll appreciate the cover that we wrote, a report in 2018. The cover said 2% mortgage rates and 40 trillion in debt. So, and you take a lot of hit for stuff like that until it happens.
Well, people don't want to, okay. When you're high on a drug, do you want somebody to tell you you're high, that you got a drug problem? No, I'm happy. Don't talk to me. People, everybody's, I mean, I hate to say this, but everybody's high on this bubble. Everybody has a 3% mortgage instead of what should be a 5 or 6%. Everybody, I looked last time I bought a car, I'm like, they're lending to me at 2%. I used to pay 6 to 7%. You know, your house goes up and your net worth goes up. Houses go up with the inflation rate historically, 2 to 3% a year recently. People's houses are going up 10, 20% a year. Their stocks are going up 20, 30% a year. We're high. When I tell people this, they're like, don't, no, they have every answer. Well, Harry, this can't happen because it can't happen, blah, blah, blah. I'm like, have you studied history or me? You're wrong. I just tell people, you're wrong. If you think this bubble can continue to diverge from reality at the rates they have, which is easy to measure, like you say, you just look at the numbers. You look at the numbers, the real economy and the stock economy. I actually have that. My spending wave goes way back and into the future. And my spending wave in good times would say the stock market should be, the Dow should be 12,000 a day, and it's pushing on 34. Now, if it has a big crash, it's not going to go to 12, it's going to go below. Just like it went above, it's going to go below. I think the Dow could go to somewhere between 5 and 15,000 the next few years. That alone is going to be a shock to the economy and people, because more and more people, I read today, 41% of people have exposure to the stock market now. Normally it's more like 20. Most people don't have, everyday people don't have a lot of money in stocks, you know. The rich people do, but everybody's in this stock market and everybody's in the real estate market. And the difference between stocks and real estate is when stocks go down, you can sell on the way down. When real estate goes down, you can't even sell. It freezes up. Nobody wants it because it's got that big thing of debt behind it and blah, blah, blah. It's a big investment. So real estate is what I'm the most scared of for people, not stocks.
Okay. Harry, hey, I've enjoyed this a lot. I really have. Let me have you give your information out for your website. And I know you have a newsletter, which I just signed up for yesterday.
Yeah, okay. Now I have a free weekly newsletter, harrydent.com. Anybody can get on. That's the way, I know I'm weird. I know we got all these outlandish forecasts. This is the way you can get to know us and see that we're actually extremely logical and data-based, like you said. But also at hsdent.com, my paid newsletter, if you put in Dent, D-E-N-T caps 25, you can get 25% off that. I think it comes out to $180. I'm telling you, I used to sell this newsletter for $400 to $500, okay? Marketers convinced me to bring it down. This is a deal. Because if I was never right about anything, just the information and research you would get compared to other people, it's off the charts. So hsdent.com for the paid newsletter. But you know what? You can't go wrong. harrydent.com. Just get on the free weekly newsletter. I and my partner will talk to you 2 or 3 times a week.
I appreciate that. I appreciate the methodology that you have undertaken as a life's work. I'm just curious, do you have people that you take their input? In other words, you're not I understand you make up your own opinion as I do, but I certainly pay attention to other people's opinion. And years ago, I'll tell you just a brief story. There was a gentleman that wrote a book, Bad Years Ahead. I'm trying to think of his name, but I read it. I was about 20 years old and I had 2 kids already. It scared me. So he said, you ought to buy 200 pounds of wheat and have water supplies. It was going to be a bad thing. So I did all that. Well, I moved that wheat for 30 years till we finally used it all. But it taught me a lesson to take input and make up your own mind. And that's what I've always done. I've never stopped taking input in, but always trying to, use my own brain because I want to be responsible. That's the one thing about predicting is you're in a blame seat sometimes where people just blindly do something and you don't want that. You want people to, hey, you study what I'm saying, see if it makes sense, land on the same square or different square, whatever you want, but do you have anybody's input that you pay attention to because you want to see what they're thinking?
Well, I have tons of people. All of my research has been built on other people's research.
Okay.
I started off not coming from economics, not having any preconceived notions, and just look. I read 10,000 pages of the history of Western civilization from some poor academic that wrote that 100 years ago. Okay, the difference between me and other people, I know I credit people when I get something from Robert Kiyosaki or this person or that. I credit them. When I got an idea from somebody else, I credit them. People steal my stuff all the time and don't credit me. So no, I have original ideas, but it's only come from looking at the great research historically of other people and putting it together in a way that, oh, I can add this twist to it, or I can research it farther and extend it. None of this stuff is totally original. I'm not original. I just started looking for answers for my entrepreneurial clients and their land. I wasn't aspiring to be an economist. I stumbled onto it like any great innovation. So no, I build on the research of tons of people. And you look at my books, I got charts, everybody gets credited. And when I get something from somebody, there's just, Lacey Hunt, Dr. Lacey, if I had to say one modern day economist today, Dr. Lacey Hunt in Austin, Texas, would be my number one person. He speaks at every conference I put on. He has arrived at the same conclusions as me from traditional economics, and I came from non-traditional economics. So of course, he borrows indicators from me, and I borrow indicators from him. But I couldn't even begin. All of my research has come from somebody. Where did I read this stuff?
Okay.
I didn't find it out. I didn't create this in a dream.
Yeah, I thank you very much for your time, and enjoy your tax-free environment.
I'm telling you, my number one thing is just keep my wife here. I would stay here till I die. I love Puerto Rico without the tax thing. And with the tax thing, I don't understand why everybody hasn't moved down here. I'm serious.
Harry, thanks so much for your time.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.